All right, we've been over some stats about the number of people that are getting 100% financing in the last 2 years at the time of this recording, which is 25% of the time our members are able to get a deal where they don't have to come up with money and they end up getting 100% financing. Also, 34% of the time they're coming up with less than $2,000, and 56% of the time they're coming up with less than $10,000. Now, what if you come up with a deal that needs $20,000, which happens about 44% of the time? Does that mean it's a bad deal? No, it doesn't. You can find other ways to make that deal 100% financing. One of those, and my most favorite way, is wholesaling that to someone else, where you take that deal, we give it to another member, the other member pays a finder's fee on that, which gets some money in your pocket, some more money. So if the next deal needs some money, you've actually got more money for that, while you're looking to get the deal, that the purchase, the rehab, the closing costs, and the payments all are under that 75%. So, and doing that. So one of the ways is wholesaling, where you're basically selling the contract and getting a fee to do that. And the great thing about wholesaling is you don't have to deal with the rehab. You don't have to deal with the resale. You get your money right up front, not when it closes. At the closing table, when they buy it, is when you get your money, so you don't have to wait for your money and you can move on and find another deal. Another very overlooked way of doing this is using hard money in combination with a home equity line of credit. Most people don't realize that they can get a home equity line of credit and use that money for anything. Now, I don't want you to go to Disneyland and spend a bunch of money on rides and whatever those turkey legs are. What I want you to do is take that money, combine it with hard money, so that you can actually make some of these deals happen that might be good deals, but not really, really good deals, where you can get the purchase, the rehab, the closing costs, and the payments all under that 75% of the after repaired value. Something else that's not tapped into enough is 401k or IRAs. Lots of times with your 401k or IRA with your employer, you can ask for a loan against it. You can get a loan against it. There may be an interest rate, but you're actually just paying that back to your retirement account. And so you can borrow against it to do the project. And when the project sells, you can pay that loan back off. So you want to talk to whoever's in charge of your 401k retirement account on that. Another one that lots of people don't think about, they may have some retirement accounts that are from some other places. You can roll those types of things over and do what's called a self-directed retirement. This would actually mean that the property is being purchased in the name of the retirement account. That means all the profits would go into the retirement account on a self-directed. There's rules around all this, but I just want to make sure that you understand these are ways to do it. Another way about this is seller financing, where basically the seller takes some of their money or all their money and gets paid when you sell the property, not when he sells the property, meaning you would pay him when you've got the property resold. Now, that may mean you're making monthly payments to him, and that may mean you don't make any monthly payments. He may get some interest, or he may get a percentage of the profits plus his money back. He gets paid before you get paid. So the lender gets paid, costs get paid, seller gets paid, and then you would get paid. Now, there's some details around this, how to set it up correctly, because we'll have to help you with that and knowing what to do. Next thing I want to talk about is called gap financing. There are people and institutions out there that will finance the gap. It's the difference between what you have and what you need. As long as it's a good deal, they may come in and say, yes, I'll bring that $10,000 or $15,000 or $20,000. And same thing, give me a percentage of the profits, or give me an interest rate or something. And those are things that you can work out. The next one I want to talk about may sound a little weird, but it's called love money, which basically means you have to ask yourself who loves you and make a list of that. And you go and talk to everyone that's on that list that may love you. It may be a mom, a dad, a grandpa, it may be a friend at work, it may be whatever, because most of the time we overlook people that would have some of that capital that would be really excited to put money into a deal. Lots of times this is a blessing to them because they've got money sitting there, don't know what to do with it. It's not making a great return. It's like, hey, yeah, I'd love to put some money in with that. So that's called love money. And you can do that with getting what's called a deal partner, which you can find somebody to do that. And you can do that through debt, or you can do that through equity. Debt means they get paid back no matter what. Equity means they're going to get their money plus a portion. But if things don't go as planned, you're not required to pay them back. Whereas with the debt, you're responsible to pay them back either way. So there's risk reward for that. And that's something you can talk to them about. You can also just get a formal business partner. You can find somebody that's a great credit and has a good amount of money, combine that with hard money, and you could do a business partnership where you're doing multiple deals together. Another one, you've probably seen this more times than not, but credit cards have probably started more small businesses in this country than anything else, and that applies to real estate as well. On most of your credit cards, you can get a cash advance. Now, that cash advance is typically quite expensive, but you can get a cash advance where you get that money and then you can wire that money to the title company to make the closing happen, or you can get additional credit cards so that you can have more cash advance to make that happen combined with the hard money. And the last one, and this one's overlooked a lot, renegotiate with the seller. If you can't make a deal happen, it's not profitable enough, it's not going to be profitable for anybody else, go back to the seller, renegotiate, and either get them to lower their price or go back to have them doing seller financing. Those are some things you can do to make sure that some alternative ways to get 100% financing that is above and beyond just the hard money loan in and of itself. Now, if you want to get super creative, you can combine multiple, right? You could combine your home equity line with a hard money loan with seller financing, or you could do your home equity with a formal business partner. So you can mix and match these to get the funds that are necessary to make this deal happen. But like I've said before, I think you should go back and renegotiate with the seller, and I think you should look at wholesaling. That's a great way to get some money and get into the action before you actually end up doing the full rehab on the property. So these are the ways to get hard money, ways to get 100% financing that is outside of hard money alone.